Hello friends, today we are going to see the final accounts. Okay, final accounts are prepared from the trial balance which we have already studied in the previous video, that is trial balance. Okay, from that trial balance we prepare the final accounts. Final accounts are of two types, that is income statement and income statement and balance sheet. Okay, in that income statement is further divided into two parts, that is trading account and profit and loss account. In this video we are going to see the trading accounts only. See, first of all, final accounts are prepared by the businessman at the end of the accounting year. What is accounting year? April to March, that is accounting year follow in India. Okay, final accounts are prepared by the businessman at the end of accounting year. This account shows the final result of the business carried out. Final accounts give a concise idea about the profitability and financial position of the business to management, owner and other interested parties of the business. Okay. Other interested parties means the financial institutions who provide the loan to your business, customer, government, supplier, all are the interested parties, or shareholders also are interested in your business. They want to know the what is your financial position, financial situation of your business, so that they will think about the future business with your organization. Okay, that's why final accounts give a concise idea about the profitability and financial position of the business to the management, owners and other interested parties of the business. There are two types of final accounts, income statement and balance sheet. Income statement are further divided into two parts, trading account and profit and loss account, and balance sheet. Income statement shows the profitability of the business. Balance sheet shows the financial position of the business. Preparation of final accounts is governed by the different acts, laws, standards and principles like Income Tax Law, Company Act, Partnership Act, accounting standards, generally accepted accounting principles used for valuation of financial transactions, events to standardize accounting information, which in turn depends upon the types of organization concerned. Okay, final accounts are prepared to show the final result of your business at the end of accounting period. Now we are going to see in detail the trading account. Trading account and profit and loss account are the two important parts of income statement. Income statement shows the profitability position of the business. Trading account is the first stage in the final accounts. Why? Because first of all we prepare the trading account from the trial balance. That's why trading account is the first stage in the final accounts, which is prepared to find out gross profit and loss during the year. Okay. For what purpose we prepare the trading account? To find out the gross profit or loss during the accounting year. It is prepared to ascertain the profit or loss arising out of buying and selling transaction. Okay, these are the important things of trading account. In trading account, we record the purchase account, sales account, purchase return, return outward account, sell return, return inward account, that we have already seen in the subsidiary books part, that is purchase return, sales account, sales return account. Okay, that balancing figure we record in the trading account. Balances of these accounts are taken in the trading account. Trading account is debited with the opening stock and purchases less return outward, all the direct expenses relating to the purchases and manufacturing, that we record in the trading account. On the credit side, sales less return inward closing stock is recorded. Remember, on debit side we record all expenses and on credit side we record all income. In expenses we record direct expenses in trading account. That's why trading account is debited with opening stock, purchases less return outward, all the direct expenses relating to the purchases and manufacturing. And on credit side, Sales less return inward and closing stock is recorded. This is the equation of trading account. Equation of trading account is gross profit is equal to sales minus cost of goods sold. And when we rearrange this equation, sales is equal to cost of goods sold plus gross profit. How we can calculate the cost of goods sold? Cost of goods sold is nothing but the cost required to manufacture the sold goods. Cost of goods sold means cost required to manufacture the sold goods. How we can calculate the cost of goods sold? That is stock in the beginning plus purchases plus direct expenses minus stock at the end. Then gross plus gross profit. This is a equation of trading account. Gross profit is equal to sales minus cost of goods sold, or sales is equal to cost of goods sold plus gross profit. What is meant by cost of goods sold? Cost of goods sold is nothing but the cost of goods sold, cost of manufacturing that sold goods. That is cost of goods sold. This is a pro forma of trading account. As I have already told you that on debit side we record all the expenses and on credit side we record all the income. Expenses, first we start the trading account with opening stock plus purchases minus purchase return, which will give the actual material consumed during that accounting period. And we record all the direct expenses. Direct expenses means what? The cost required to manufacture the sold goods. These are the direct expenses. Okay, cost have three components, that is material, labor and expenses. That direct material, direct labor and direct expenses we record on the debit side of the trading account. Carriage inward, wages, freight, custom duties, fuel and power, factory expenses, royalty on production, all are the direct expenses we record on the debit side of the trading account. And on credit side we record gross sale, by gross sale less sales return, which will give the net sale, and closing stock, that will give the total of the credit side. Okay, and after recording all the expenses on the debit side and all income from the credit side, we find out the total of both the sides, debit and credit side. If the total of the debit side is more than the credit side, means if the total of the debit side is more than the credit side, means it represents the loss. To balance both the sides, we have to record by gross loss CD, that is carry down that amount if the debit side is more than the credit side. Okay. And in reverse case, if the credit side is more than the debit side, means what is the result of the operation? That is profit, that we record on the debit side to gross profit carry down. Okay. This is all about the trading account. Either profit or loss is occur at the end of the accounting period. I have mentioned here both, but don't confuse from this. Okay, either we record the loss or profit only. Okay, on debit side we record the expenses, on credit side we record the income. If credit is more than the debit, that is the profit that we record on the debit side to gross profit carry down, and that profit we transfer to the profit and loss account. And if the debit side is more than the credit side, the result of the operation is loss, that we record on the credit side as by gross loss carry down. That loss we transfer to the profit and loss account. Thank you.